Good morning and welcome to the Killik & Co market update. It's been a difficult week for markets, with US indices falling into what we call correction territory, which means a fall of 10% from the previous peak. Markets have been spooked by Donald Trump's threats of further tariffs. This week he threatened tariffs of 200% on European alcohol. Here's how markets have been moving this year to date. The S&P 500 index is in the pink. It's down over 10% since that record high back in February. The Nasdaq Composite in the purple is down slightly more, but what's interesting is that European indices are up on a year-to-date basis. The FTSE Euro 100 index is shown in the green. European stocks have reacted positively to the expected relaxation of the German debt rules that we talked about in last week's video. The year-to-date performance is quite a reversal from the performance over the last decade, which has the Nasdaq very much in the lead and European equities very much in last place. Back to the market correction that we're experiencing at the moment. Obviously, these sorts of market falls feel very unpleasant while they're happening, but it's important to remember that they're actually very common. Here are all the corrections the S&P 500 has experienced during the last 15 years. There are 9 on this list, and that doesn't include the current one. This table shows when the index peaked and when it hit a subsequent low point, and the percentage loss between those two dates. The fact that the S&P 500 hit a record high last month demonstrates that it had recovered from every single one of the corrections or crashes on this table. We've seen stocks in different sectors, different countries, and different currencies performing in very different ways over the last couple of weeks, and that supports the view that it's a good idea to have a diversified portfolio. During the last couple of years, there's been a lot of talk about the Magnificent Seven stocks: Nvidia, Tesla, Alphabet, Amazon, Meta, Apple, and Microsoft. At times, these large companies have been responsible for driving the market higher, but during the recent sell-off, they have underperformed the wider market. As a reminder, the S&P 500 index is a market capitalization weighted index, so larger companies have a larger weighting in the index. Here are the current top 5. Apple accounts for over 7% and Nvidia over 6%. These 5 companies account for a massive 26% of the index, meaning the other 495 companies must collectively account for 76%. As well as following the S&P 500 index, we also follow the S&P 500 Equal Weighted Index, which is a version that gives all 500 constituents an equal weighting. Year to date, the Equal Weighted Index in the green has outperformed, suggesting that these big tech stocks in the ordinary index have underperformed. This is the opposite to what we've seen over the last year. As you can see, the ordinary S&P 500 index has outperformed thanks to those big tech stocks. Another factor impacting portfolio performance this week has been exposure to the US dollar. Here's the dollar against the pound over the last year. Back in January, a dollar was worth over 82 pence. Today, a dollar will only buy 77 pence, and that's a weakening of over 6%. Anyone holding dollar-denominated stocks but valuing their portfolio in sterling will have been impacted by this dollar weakness. And lastly, this week is the 25-year anniversary of the Dotcom bubble, so we've been looking at the market and reflecting on how far it's come since then. Here's the Nasdaq Composite going back to 1990. You can see that bubble building up in the year 2000, followed by the crash. The index lost 78% of its value between 2000 and 2002. Technology stocks have been very much in favor in recent years, and we're often asked if now is different to the dot-com bubble, and the answer is very much yes. During the bubble, investors were buying into companies that weren't profitable, but these days, technology companies are very profitable indeed. We can see this by looking at the price-to-earnings ratio of the Nasdaq Composite Index, which is very tech-focused. As a reminder, the price-to-earnings ratio is calculated by dividing a company's share price by the level of earnings or profit that can be attributed to each of its shares. The higher the ratio, the more expensive a share is considered to be. If you look at the formula, you'll see that companies with low levels of earnings will end up with higher ratios, but companies with higher earnings will end up with lower ratios. The price-to-earnings ratio for the Nasdaq Composite Index went above 200 during the 2000 bubble. This year, even when the index hit a record high in February, the ratio was a much more palatable 35. Share prices have come down since then, so today's ratio will be even lower. Moving on to have a look at next week, we're expecting results out from Prudential, Nike and Accenture. That's it from us. Have a great weekend and we'll see you next Friday.